I'm going to say something contentious. I think inflation is negative in 18 months.
Everything.
I don't think prices fully come back down. They never do. They never mean revert. But I think we will see an unwinding. What you're seeing is what happened 18 months ago. This is how things work. It has to go through the supply chain. So the issue of you not being able to get stuff, and I've got the same issue, can't get stuff, that's 18 months ago problem. The actual problem being faced is who the hell are GM going to sell those cars to? What we're doing here is we are seeing the tail end of what happened 18 months ago. I think that's going to be dramatically reversed because the supply chain issues are really not as bad. Now, there are issues within commodity markets like oil where we haven't had enough spend. But I don't see a massive increase in demand for oil. Chinese economy is slow. We've got aging populations everywhere. The demand for oil is the 5-year on 5-year rate of change of oil demand is negative. I don't see the demand story. I see a supply story, and there's a lot of people looking at commodity markets going, yeah, oil's going to $200. Yeah, if you can get demand back to where it was, we're assuming it is. And people are extrapolating demand post-COVID, which was a stop of demand, re-release of demand coming back on. That demand goes back down to trend. So I don't see it. So I'm guessing that as oil comes down to $60 or so, as everybody gets washed out now, most commodities are down 50%, so that would be about right, from $120 to $60. How fast does it recover? Well, maybe it recovers reasonably quick because the supply issues, and after a recession, there's a recovery. Are we going to go screaming through $120 and have rates of change that lead to inflation? I just don't see it. Now, the other argument people have is reshoring. Well, reshoring is going to create inflation because we need to build all these factories. I've got as clear a view as I could possibly have. You know, nothing is a certainty, but for me, the macro is rolling over. By that, I mean we're going into recession. We should see the things like the ISM survey and other things start falling apart pretty quickly. The forward-looking elements are falling apart already. We're seeing it globally. So that's growth evaporating. Alongside that, the narrative hasn't caught up. Most commodities are down between 30 and 50%. Oil is the last to crack, and I've been talking about this on Twitter. I've been writing about it for a period of time. Is everyone's long and expecting oil to go to $200. I think there's a washout coming and it goes down to 60. So that's the last inflation story. Everything else from the raw goods then comes into the supply chain and then eventually starts fading. So we're going to see that inventories, because people build massive inventories after COVID. Those inventories are now unsold because of the economy slowing down and inflation eating disposable income. So we've seen it from Walmart, Amazon, and others. They're going to start discounting inventories to try and shift it. People are laying off staff. So the macro cycle is going to get to the ugly phase. Okay, why is that making Raoul bullish? Well, because the outcome to that is as inflation comes down and bond yields fall, liquidity conditions improve. And what drives financial markets at the macro level the most is liquidity conditions. We've just gone through the largest tightening in financial market history because the rate of change of interest rates going up was the fastest ever. Mortgages are back to where they were in 1996, and it's shocking. Then the dollar went up at a rapid clip, which is a tightening of financial conditions, and then commodity prices went up. So basically everybody's suddenly skint, as an Englishman would say. Nobody's got any money, and the economy implodes. The forward-looking indicators suggest to me that this goes off a cliff fast until we probably bottom Fed March next year. That's the economy. What we end up with was a position where the big thing that correlates to crypto markets overall is some definition of liquidity, and you can use M2, global M2 year on year. That looks pretty much like Bitcoin year on year, or crypto market cap year on year. We're at the very bottom. It usually turns around at this point because eventually the outcome is central banks have to provide liquidity in a recession because there's no liquidity. So forward-looking assets like crypto are picking it up. So they also have perfectly correlated to the turning points in the inflation cycle. So they kind of time the bottom, and I think it's time the top. So basically, I think crypto is saying, okay, inflation has now peaked, and therefore the marginal pressure from tight liquidity is gone. So my view is, with, let's give it a probability, 70% probability, so that's pretty high conviction, that the low is in. And therefore we're starting the upside cycle. So the macro, I think, for me, even though everyone thinks, oh my God, it's terrible, the equities are going to sell off. Well, the equity side of the equation, that correlation with equities was actually a correlation to liquidity. They're all actually correlated to the macro cycle. Can equities sell off further? Yes. Can crypto decouple? Yes. We saw that in March 2020, that crypto started going up when equities were going down, because crypto is more forward looking. However, equities have actually priced in quite a lot already. So it's not 100% clear whether equities need to go down or not. So I did a Twitter poll recently with like 20,000 people responded, which was, do you think equity markets have further to fall? 70% of people thought so. This is like, everything else can be priced off it. So it can be ETH plus 400 basis points, which is how the world works in traditional markets. I think everything should get priced off ETH. So it'll be
prime rate.
So we can now trade risk more efficiently. You know, part of the issues we've seen is you didn't know what risks was what. Now we can do that. So institutions love yield. They don't like Bitcoin. They don't like Bitcoin because the ESG narrative, and they don't like Bitcoin because it doesn't yield anything. So now you've got a cryptocurrency that is basically access to a technology of gigantic proportions that pays a yield and has negative supply. So this is basically Google giving you 8% yields and buying back their shares.